Welcome back. We were going over study problem 3-12 from chapter 3, page 89. We are already done with the first part and we came up with our free cash flows. Now we need to also construct financing cash flows. And so this way we'll have a very good understanding of how cash flows are being used and what are the sources of those cash flows. So we can directly dive into the problem. So let's recall the financing cash flows formula. It has 5 components and each component is pretty much straightforward. So let's start with the very first one, change in short-term debt. All we need for that would be to look into our balance sheet and see if we have any short-term liabilities. And as you recall, we have only 2 short-term liability items in our financial statements, balance sheet, and none of these bear interest. So as a result, the change obviously for short-term liabilities is simply 0. Now the second part, change in long-term debt. Now we have some long-term debt here. At least one item that I can see right away would be the mortgage payable, and we need to look at the change. So obviously in the previous year that figure was $70,000 and we were able to pay off our mortgage, and now it is basically 0. So therefore the change in our mortgage payable would be 0 minus $70,000. So we used cash for that purpose. 0 minus $70,000 plus. Now the third part, so we're done with the second part. The third part is kind of, we need to be careful on the third part. So when we read the third part in our formula, it would be the change in equity. However, do not take into account retained earnings if any is given. So let's go back to our balance sheet and figure that out. So what are our equity items? We have 3 of them here, as you can all see. The first one is preferred stock. Then the second one would be common stock, and the third one is retained earning. Remember the formula, change in equity, however, omitting retained earnings. In that case, we will only focus on the first 2, preferred stock and common stock. So all we need to do, find the sum for the most current year and subtract the previous year figure from that. So the sum for the most current year is $325,000, as you can see, and the sum in the previous year was $205,000. So therefore we are looking for this difference here, 325 minus 205. So here 325,000 minus 205,000. Now we are in the fourth piece, dividends paid. So let's revise our formula to make sure it is dividends paid. And let me continue from the second row here. So I will just make sure not to forget to put the minus signs for dividends and interest expense. Interest expense would be our 5th item, obviously. So dividends first. For dividends, obviously we need to look into our income statement. We realize that dividends paid has 2 pieces. The first piece is preferred stock dividends, and in that case that would amount to $10,000 preferred stock dividends paid. And second of all, the firm also paid common stock dividends, so in the amount of $22,000. So we need to consider both of these in our calculations. So now let's go back. So that would give us a combined total of $32,000, obviously. So that won't be the slide, yes. So we have 2 pieces here. The $10,000 paid for preferred stockholders, and then the $22,000 paid, oh, that's a plus, paid to common stockholders. Finally, we have interest expense, and again, we need to go back to our income statement for that figure, and it should also come out as, well, yeah, as you can see, we actually previously used that figure earlier, and it is $4,000. Now let's move backwards. So that figure is $70,000. And we're pretty much done. All now we need is to come up with the calculation. So the first number will give us minus 70,000. From here we will get $120,000. Minus from this one we will get $32,000. And finally we will have minus $4,000 for interest expense, totaling all these together. So from the first two we should come up with 70,000 subtracted from 120 will give us 50,000, and then further deduct 32,000 we will have 18,000, and then further deducting 4,000 we will have $14,000. However, here we scratch our head because, well, that figure was supposed to be in match with what we found in our other calculation for free cash flows, and obviously that's not the case, because our free cash flow came out as $42,000, whereas financing cash flows currently is $16,000. So we've made an error in our calculation, so we need to fix that. So I'll give you a few minutes, and in the third part of our lecture we will try to figure where the error came out from. So try to see if you realized where we messed up in our calculations.